For generations, the local bank has been treated as a sanctuary, a place where you park your life savings, with the absolute certainty that it will be there when you need it. That was the expectation for Kumar Awasthi, a retired Army officer. When a family friend and branch manager suggested a super FD, designed specifically for senior citizens, it seemed like the safest possible home for his savings. But the chart of Kumar's investment tells a different story. The Super FD was actually a deceptive label for high-risk AT1 bonds. When the bank collapsed, his entire life savings, 1.36 crore rupees, were completely wiped out. Despite selling a fraudulent product that destroyed a customer's future, the branch manager faced no repercussions. Instead, he was promoted and remained at the same branch. In this environment, the very relationship that makes banking possible, trust, has been transformed into a point of vulnerability for loyal customers. This isn't a story about one rogue branch manager. It is a standardized process occurring across the country. Farmers are being told they can't get crop loans unless they buy life insurance. 80-year-old citizens are being sold a dozen different policies they don't need. Construction workers are being handed credit cards disguised as simple debit cards. It is easy to look at these examples and blame the bank employees directly in front of us, viewing them as hunters looking for a quick commission. However, those same employees record rates, reporting extreme stress, heart disease, and in the most tragic cases, taking their own lives. We are looking at a system where customers lose their savings and employees lose their health, yet the volume of these sales continues to climb. To understand why this is happening, we have to look past the branch floor and into the corporate revenue model. Banks have a traditional engine, interest income. They lend money, a slow process with high default risk. The secondary engine is non-interest income, fees from third-party products. It carries zero risk, massive rewards. Banks can pocket 65% of a premium as immediate commission. The scale of this shift is massive. In 2024 alone, India's top banks harvested 21,000 crore rupees just from these commission fees. This revenue shift creates a conflict of interest, where a bank's immediate profitability relies on selling products its customers may not actually need. The pressure to capture that 21,000 crore rupee pool lands squarely on middle management. Boardroom demands for higher profits become impossible targets, pushed down to every relationship manager. Managers use aggressive tactics, like verbal abuse, leave denial, or punitive transfers. To keep their jobs, honest employees are forced to aggressively missell products as a survival strategy. The fraud we see at the branch level is the direct, calculated result of how the boardroom has structured its incentives. Altering this ecosystem requires intervention from the regulatory bodies that set the rules of the game. The solution is found in behavioral psychology. Change the financial incentives, and human behavior follows. Regulators can stop this by abolishing upfront commissions. In 2009, SEBI successfully did this for mutual funds by mandating a trail-based model, where the bank's fee is paid out slowly over the life of the product. They must also implement strict clawbacks. If a customer cancels a policy within a few years, the bank should be forced to refund the commission in full. Tying profits to the customer's long-term financial survival removes the financial logic that currently rewards a short-term scam. While we wait for those rules to change, there are steps we can take to protect the person sitting across the desk from a bank manager today. We need radical transparency. Every contract should be forced to display the distributor price, which includes the bank's cut, directly next to the direct price available without the bank's involvement. Internally, relationship managers should be graded on customer suitability scores, measuring if a product actually fits a customer's age and risk level, rather than raw sales volume. Ultimately, the Reserve Bank of India has the authority to ensure that banks act as guardians of the public's money, not just as sales agents. Every short-term fee collected through these methods costs the banking industry a portion of its long-term public trust. Until the incentives change, your local bank is a high-pressure sales floor, and your greatest protection is your own caution.